to the next topic, which is pensions. So when I say pensions, I'll focus more on the defined benefit schemes because that's more related to the actuarial world. So it's no secret that the defined benefit schemes, pension schemes have been in decline for a number of years. So the vast majority of these schemes are either close to new members or close to new accrual. And most of them are cash flow negative. So therefore, many DB schemes are now looking at how to continue to provide the benefits to their members whilst minimizing the costs and risks to employers. So traditional approaches to this endgame scenario have been insurance solutions, for example, like bulk annuity transfer, or some call it buyout. But alternative consolidation mechanisms are now emerging. So like super funds, where DB schemes or different DB schemes can be pulled together and run by a third party. So has COVID changes the end game? So my pensions colleagues have conducted research recently on FTSE 350 companies with DB schemes. They concluded that while some schemes have weathered the recent market volatility relatively fine, funding levels for many schemes have worsened. So coupled with difficulties facing UK business, reaching the DB endgame now will be a greater challenge for a lot of the schemes. So based on our research, the number of DB schemes that will be in a position to buy out within the next 10 years was 65% at the end of last year. But by the end of June this year, this number has fallen down to 55%. And on average, the market crash has pushed back the scheme's endgame by around a year and a half. So as I mentioned, bulk annuity have traditionally been seen as the most secure way of transferring the benefits to pay, ensuring that the benefits are paid to the members, because insurer assumes full responsibilities of these future liabilities. So many scheme sponsors will aim at using buyout as their final end game. And as you can see from the slide, the transactions in the bulk annuity market has steadily been increasing in the last few years, so reaching 45 billion in 2019, which was an exceptionally good year. So far, we've seen around 10 billion of transactions in the first half of 2020. So despite COVID, this market is still pretty active. And our bulk annuity expert at BW is expecting the full year figure to be around 20 to 25 billion, which would be a similar level to the 2018 level. So the market volatility is there. However, for schemes that are in position to do a transfer now, they would have received sufficient capital already and don't need to rely on the sponsor that much. So they can still ready to they're still ready to be able to go ahead despite COVID. So as mentioned previously, super funds is also an endgame option now, and it's a cheaper option to transfer. So there are 2 super funds approved in June by the regulator. So we may see some schemes going down this route in the future. And we believe that it will take some time for the bulk annuity market and super funds to work out how to coexist with each other. And ultimately, the choice of endgame strategy will depend partly on the financial situation of the scheme and also on the appetite of the sponsor. So moving on to my final topic now. I just want to quickly touch on risk management, because I think risk management plays a vital role in any business. So stress and scenario testing, called SST, is a very useful tool to see if your company's capital and balance sheet can withstand various types of stress and shocks. And as head of actual functions for many of my clients, Since the beginning of lockdown, I have been asking them whether they have considered future pandemic scenarios and whether these scenarios are severe enough to demonstrate that the company have sufficient capital to cover these circumstances. And as part of the scenario testing, reverse stress test is also a very important part of the tool, which should also be reviewed in light of the pandemic. And for those of you who work in capital modeling or involved in validation in the London market, this year, Lloyd's of London expects to see impact of COVID modeled in Syndicate's internal model. And this is one of the key areas of focus of model validation. But money cannot solve all the problems, just like in real life. Some risks are operational and need to be dealt with differently. So last year, UK regulators jointly issued a suite of consultations designed to improve the operational resilience of firms and protect the wider financial sector and the UK economy from the impact of operational disruptions. So they aim to set a new operational resilience requirement by 2021. And these requirements will apply to UK banks and insurers. I won't go into detail now, but if firms can demonstrate they remain resilient to further stresses to their business, their customers and other stakeholders are likely to have more confidence in its ability to keep the business going in times like this. So firms should look to show they understand the operational processes within their business and consider how stresses to key process resources and wider services will affect their business. And lastly, we should take stock on what's happened so far. So based on the history of pandemics, there's a very high chance that there will be a second wave, maybe a third too. The Spanish flu in 1918 that lasted for 2 years had 3 waves, with the second one more deadlier than the first one. So the question I'll leave you here is, are you or your firm prepared for the second wave or even more? So as my last slide, I will leave you with a framework that we came up at EW, which helped to design COVID-19 scenarios. We have looked at 5 key factors when considering the possible COVID-19 second peak. So the first one is the timing of the second peak. We've shown 6 months, but it might be, some may argue that it's already there. We are already seeing second wave in Europe. And my parents are saying it's the third wave in Hong Kong. So the second layer is with how severe this peak might be. And then the third is we consider the severity of the recession. And the last 2 layers consider how government may respond to a second wave in terms of the lockdown measures. And the last one is the economic stimulus package. How will they react to that? Or what support they will provide. So these can be applied to any geographic locations, and different countries may be impacted differently. So for example, going back to the beginning of my presentation, UK's GDP or unemployment rate may be affected more than other developed countries. So if you apply this to US, your outcome might be different. So of course, there are many other possibilities you can add in. For example, when the vaccines will be available. But hopefully, this will give you some ideas on how to generate the scenarios to apply themselves. So in summary, COVID is here to stay in the near term. And the short-term economic outlook is not looking very good. But the positive news is, governments are trying their best to help the economies. So hopefully this time next year, we'll have some more positive news. And all industries are affected but there are things that we can do ourselves to make our companies more resilient for the next crisis. So that's it from me. Thank you for listening.
Thank you, Cherry. This is a great overview of the COVID-19 implications. I have a few questions here, but due to the time constraint, I'll just pick one, and then Cherry, maybe you can just answer the rest separately after the webinar.
Sure.
So the question I have here is regarding your slide 20 on the bulk annuity market. Given the transaction in bulk annuity in 2020 is declining, do you see an increase in the demand for the pension schemes to seek super fund route, or do you see the big market for the super fund model in the next couple of years for those who are not ready for the annuity buyout or buy-in?
Yeah, so I think whether the schemes will go down the bulk annuity or the super fund routes, there are different criteria. So I think the more mature ones might be more ready for the bulk annuity route, and the funds who may be less capital available may look to go down the super funds route. But it depends on a lot of things, because I think super funds is run by third party, and as I understand it, there might be other investors that could invest in the super funds. So yeah, it is possible that funds are mutually exclusive. So they might go down. Some routes might be for bulk annuity, and some funds might go down the super funds.
Okay, great. Thank you, Cherry. Thank you for taking the time to present on this topical subject.